Well, all right. Well, welcome everyone to this month's segment of Balanced Wealth Management, adding value to everyone. And today we're going to be talking about Roth conversions. We got our CEO and fearless leader, Bob Gavlak, certified financial planner. And I know that's still relevant because I think you just busted out about 36 hours of CE credit this weekend. So way to go, Bob,
I
staying
did.
relevant. Bob really is a consummate planner. He studied finance and business back in college there in Cleveland, and incredible family man, a real planner, really helps us with the direction of the firm and has helped all of our clients for the last 8 years we've worked together, Bob. So we're excited to hear this conversation tonight, how to maximize. One of the best ways you can save money is really taxes and fees. And so tonight we're going to talk about how you can moderate and take advantage of some tax planning using a Roth conversion strategy. And Bob's going to make it as fun as this topic possibly can be. Quite educational. He's got a lot to get through, and there'll be plenty of time for Q&A at the end. So feel free to ask questions. We'll get to them along the way, and certainly at the end, we'll leave some time open. So Bob, without further ado, man, I'm going to hand it over to you. By the way, my name is Tim Power. I'm a partner and a financial architect at the firm. I forgot to introduce myself, but Bob, we'll pass it over to you and take it away.
Yep. And all that art behind Tim is Tim's art. He is our resident artist on the team as well. If you're interested in art, talk to Tim because I am just atrocious at that. But thank you, Tim, for the intro. And thank you, everybody, for being on here this evening. Looking forward to walking through this with everyone. Well, maybe not walking through it. I will go kind of quick because there's a lot I want to get through and a lot we want to cover as it comes to Roth conversions. So I'll just be walking through this presentation with you. At the end of the day, what we want to do here at Balance is simplify your investments. But as I talk through this topic, I am going to go quick and I am going to cover a lot because I want to make sure everybody understands what's going on behind the scenes. And when we make a recommendation for something like a Roth conversion, there's certainly a lot more behind it. But at the end of the day, our job is to simplify your life. And at the end of the day, really make sure that we're minimizing the amount of tax you pay over your lifetime, not just tax in a year-by-year basis. So that's what we're going to cover with Roth conversions today. So is this for you? If you have an IRA of any kind and you want to consider a Roth, converting it to Roth, if you are worried about where tax rates may go in the future, I heard somewhere we might have an election coming up somewhere soon. I don't know. Other people might know something about that. I've been getting lots of texts from Kamala and Trump. But tax rates may go up in the future, so we want to consider that. If you're okay paying some extra tax today in exchange for tax-free income in the future. And then I stole this from Nick. For those that were on our last webinar, you have trouble going to sleep and this webinar is conveniently close to bedtime. So hopefully we can cover all of these things as we go through it. Excuse me. Again, another slide I stole from Nick here for those who are on our tax loss harvesting and direct indexing webinar. We want to build a financial plan that has a strong base of a lot of different topics and a lot of different strategies. And so today we're going to talk about another piece of this, which is Roth conversions. So we already went through the agenda or the introduction here, but I'm going to start with just simply what is a Roth IRA conversion? What does it mean to do that? What is a Roth IRA? Very basic. What are the rules for the tax-free distributions out of Roth IRAs? I'll go to marginal tax rates. I want to talk about how the United States federal income tax system works, because that ties into the planning that we do when it comes to these Roth conversions. I'm going to try to tie it together with a case study. Then we'll have considerations and next steps and questions and open floor. I was talking to Ryan at the start of this, and you all should have an opportunity to put questions into the webinar at any point. I'm happy to take questions along the way if it makes sense for me to pause and go back to something a little bit, but there will be another opportunity at the end, and I'm happy to refer back to whatever we need. So feel free to ask questions, to interrupt, do all that stuff. But I'm just going to get into it and start flowing through. So we're going to start with just what is a Roth conversion. And I want to start with a concept called the tax efficiency ladder. And I've had this pretty picture of a ladder here, and there's basically 3 rungs to this ladder. At the lowest, are taxable accounts. These are brokerage accounts. These don't have any tax qualification. So every year, if you sell something or you realize income, you're getting taxed on this on an annual basis. There's no tax protection there. The second level is a tax deferred account. IRA and 401k are the most common ones. This one, you defer the tax, but when you take the money out, you're going to get taxed at ordinary income tax rates. It's great for deferring income while you're working. Quite honestly, it's not the best when after you retire and you've got this big chunk in deferred accounts in your IRA, then every time you need money, you have to pay tax on it. So we'll talk about that. And then at the top rung of the ladder are Roth IRAs that are the only tax-free account out there. HSAs can also be a tax-free account, but they aren't as easily accessible as Roths. So what we're going to talk about really is Roths and Roth conversions for this webinar here this evening. So getting money up the ladder, if you want to get money up into a Roth, there's two ways to do it. There are contributions and there are conversions, and they are two different things. So a lot of times I hear the clients get confused with this. They're like, well, I thought I could only do so much for a conversion. You're thinking about what is called a contribution. So I want to cover contributions quickly because this is a way you can get money into a Roth without doing the conversions. And especially for those of you who are still working, Roth IRA contributions or Roth 401k contributions can make a ton of sense. So a contribution, simple enough. You're just writing a check from your checking account, moving it up to your Roth IRA. So there's no tax deduction for it. You don't get to remove that from your income, but you move it up the tax efficiency ladder and you're going to get tax-free growth going forward in the future. The two restrictions here, though, one, you have annual limits to a Roth IRA contribution. You can only put $7,000 in or an extra $1,000 if you're over 50, and it's subject to AGI limitations. And I'm not going to go through all this detail here, but in general, you need to make sure that you qualify to make direct contributions. Now, conversions are a little bit different. What's happening with the conversion is we are converting an IRA to a Roth. We're basically moving the money from IRA to Roth. So if we had $20,000 in our IRA and we convert it to a Roth, there's now $20,000 in our Roth IRA. But what the IRS sees is they see a step. They see it as a distribution from your IRA, and then we're pushing it to the Roth. And effectively what you're doing is you are realizing the income for this conversion in this tax year in exchange for moving it up the tax efficiency ladder so that we get into this tax-free account. So again, we are paying taxes today when we do these conversions in exchange for this tax-free growth in the future. And with conversions, you don't have any annual limits. You can do as much as you want. You could do $1 million conversion if you wanted to, and the IRS would welcome it. They'd be like, yeah, sure, go ahead and pay taxes on $1 million of income, right? It also has no AGI limitations. There's no rules for how much income you have or make in order to get money into a Roth through a Roth conversion. So any of our clients, you all are able to do this regardless of your tax filing status or income levels or anything like that. The only thing that we need to be aware of is how to get money out on a tax-free basis. There are two rules for it. One, you need to be 59 and a half. And two, the money needs to be in a Roth IRA for at least a period of 5 years. Now, there's some nuance to this, a couple of things. First of all, you can always get your contributions out tax and penalty free. So if you put in $5,000 into a Roth and 3 years later you need it and you're only 32 years old, you can always get that money back out. You just cannot take out the growth on within any Roth IRA until both of these rules are satisfied. So with that, for some of our clients who don't have a Roth IRA yet, you might look at this and say, well, geez, I need to wait 5 years before I can take this money out. That is true. But again, there's some nuance to it, and we want to start that timeline as soon as possible. So if we're sitting here in 2024, right, kind of near the end, this is a good spot. If you just went and everybody on this call took and put $10 into a Roth, and this is literal $10, right? Like, you know, but it could be 100 or 1,000, whatever the number is. Whether you contribute it or convert it, your 5-year clock starts January 1st, 2024. If you do nothing else until 2028 and, you know, some political, action. They changed the IRS rules and tax rates are going to go way up starting in 2030. And you're like, oh, geez, I want to convert a big chunk, right? $100,000 in 2028. You go ahead and convert it. All of a sudden, what's happened is, okay, let's assume that you are 59 and a half. All right, let's just kind of take that as an assumption. The account was funded on 1/1/2024, so you can withdraw on 1/1/2029 any growth from your Roth IRA 100% tax-free, even though only a little bit has been in there for that 5-year period, and the majority of it went in just 6 months earlier. You now have complete flexibility that, yes, you can get your contributions out at any time, but now you can take out the growth as well. Whereas if we sat in this webinar and you're like, yeah, I'm not going to worry about it, it doesn't seem to make sense, and you just left it alone, and then the same IRS rules came out and you're like, oh, shoot, I really should have done some conversions, and you do that in 2028, now all of a sudden your 5-year clock doesn't start until 2028, and you have to wait until 2033 to take out the growth. So just to be clear, it makes a ton of sense just to go ahead and get even 10, 100, 1,000, whatever it is, into a Roth IRA or Roth 401k, right? This applies to either one to get the 5-year clock started. Okay, so again, everybody, I know I'm going quick, but I want to cover all this because it ties back to everything that we talk about from a planning perspective. So let me take a quick breath. And what we're going to dive into next is marginal tax brackets and how the tax system in the US works. Ryan, are there any questions? Are there anything that I need to pause for to go back to?
Nope. No questions have come in yet. All good.
Okay, great. So I'm going to walk through marginal and effective tax rates and how we use them for planning. I want to walk through how the tax system works in the United States. This is our federal income tax system. I'm not going to talk about states. We're just going to kind of leave it to the side because we have clients in Colorado and Ohio and South Carolina and Texas and all over the country. So that's another moving part. But for this, just want to talk about how taxes work in the United States. So let's say we've got a married couple here. They make $133,000. That's their gross income. If we look at the 2024 marginal tax rates, here they are right here, and I'm going to round numbers here, folks. Just bear with me. I'm not trying to get the math exact. I'm just trying to show for illustrative purposes how it works. So the first $30,000 of your income, if you make 133, is actually taxed at 0% because our standard deduction is about $30,000. That is not going to get taxed at all. So there's no tax on that first 30. Then that first step is about $23,000. It gets taxed at 10%. The next step is about $70,000. It gets taxed at 12%. And then the last bit is $10,000. It gets taxed at 22%. So this is $133,000 broken down by marginal rate. This client would be in the 22% marginal tax bracket. Now, what a lot of folks think and they get worried about is they're like, oh, crap, Bob, I don't want to bump into the next marginal tax bracket. I'm going to get crushed with taxes because there's this misconception out there that if we cross into the next tax bracket, that it impacts all the other tax brackets down below it. It says, okay, I'm up in 22. Now everything's getting taxed in 22. That is not the case. All it is the dollars going up from there get taxed at the 22% marginal bracket. So it doesn't impact the dollars below, only on the next dollar that you earn. So if we look at and kind of multiply this out to get the amount of tax they pay nothing on the first 30,000, pay 2,300 on the next 23,000. You'd pay 8,400 on the next 70,000. You pay 2,200 on the last bit. Your total tax would be about, again, federal income tax bill will be about 12,900 for an effective tax rate of about 10%. Now, when we think about the short-term planning and Roth conversions is, short-term planning, which one do we think is more important? It's definitely, I'm just going to skip to the answer for you guys. It's the marginal tax bracket. And this is more important for near-term planning because it applies to the next dollar of your income. Effective tax rate can be important for kind of long-term planning to understand what our net tax bill may be. But for near-term planning, marginal is most important because if we go back to this couple and they now make 143 instead of 133, All that happens is that 10,000 goes up to the top, goes up to their marginal bracket. They get taxed at 22% for a tax bill of an additional $2,200. So that 10,000 didn't impact any of the dollars below it. It only added an extra $2,200 in tax. Their total tax bill went up to 15,000. Their effective rate is still only about 11%. So again, this is how the tax system works. And where we can use this to our advantage is, what if one of these tax brackets isn't filled up? How do we take advantage of that? How do we plan for it? So let's look at this, a different couple that they're not doing as well. They're only making 93,000, or they only have 93,000 of taxable income. Well, the same process happens. 30,000 is taxed at 0%, 23,000 is taxed at 10%, 40,000 is taxed at 12%. They have this bill. But the issue is that this 12% marginal bracket, which I would argue is a really low tax bracket, that is a deal to pay 12% income tax on your income that you're getting. Y'all might not feel the same way, but I promise you, or at least how I'm looking forward, I feel 12% is a deal, right? So what we want to do, that is right there, the opportunity to do a Roth conversion, to move from IRA to Roth, to take that taxable distribution and fill up that marginal tax bracket. So if we, instead of it being not full, we fill it up with a $30,000 Roth conversion, what happens all of a sudden is, now we know that, hey, we're only going to get taxed at 12% for this $30,000. That's a $3,600 tax bill, additional tax bill, that is going to hit you in this tax year. But what you've done is you paid off Uncle Sam on the front end and said, you know what, I'm going to pay you off in exchange for, now this $30,000 grows tax-free for the rest of my life, and I don't have to worry about what happens with tax rates. Okay. So filling up this hole that we have, and I'll talk about what's called a income valley here shortly, but this is the planning. This is what we want to do. And this is why, understanding your income year by year, we can understand what will be the impact of doing these Roth conversions. So I'm not going to give my answer to this question. I think that you can probably infer from how I talk what my answer is. What do we think will happen with marginal tax rates beyond 2026? Do we think they're going to go down, or do we think they're going to go up? Right? That's kind of the question we have to ask ourselves and think through. And comparing that to where we're at today can make a lot of sense to do Roth conversions. So I just talked about how the tax system works, and I know that I'm going quick, and I apologize, but I want to get all this baseline in here. But at the end of the day, it's like, Bob, why do I want to elect to pay extra tax, even if it's only $3,600, right? Why do I want to do that in exchange for the future? So let's talk about the planning behind Roth conversions and how we tie this in on a client-by-client basis, and what it can mean for you if we take control of it and we do it right. So before I dive into this, I have to put a disclaimer up on the screen, right? This is a hypothetical example. This is not an actual client example. Everybody's situation is different, and this does not guarantee that any of this is going to work out exactly the way that I have it illustrated in this hypothetical example. But the ideas, the theories, the tactics, the strategies behind what I lay out is exactly what I do for each and every one of our clients, and I'm happy to do for each and every one of you as well. So just a little disclaimer here, just to be very clear. So we've got Bob and Bonnie here. I was selfish, I used my name as well, but we got Bob and Bonnie. They're 60 years old, a couple of kids. They want to retire in a couple of years. They've got some income coming in from Social Security, kind of your standard setup. They want a comfortable lifestyle in retirement. They want to optimize their tax bill, and they want to preserve as much as they can for the kids and grandkids. Now, they want to, enjoy their life, enjoy their money, right? But they, if something can be left for the kids, great, So, and this number two, again, I said it at the beginning, and I always like to reiterate it. I don't want to optimize a tax bill or a tax strategy on a year-by-year basis. I don't want to minimize the amount of taxes in one year. I want to optimize it over the course of our clients' lives, that over the next 15, 20, 30 years, that we're paying as little tax as possible over that span, not just year by year. So that's what I mean by optimize, which is different oftentimes than a CPA. So
Hey, Bob,
do you
we
have a
do,
question, Ryan? Or
yeah, we do have one question. What time of year does this action need to occur?
It's a great question. A Roth conversion needs to be done within the tax calendar year. So if you wanted to do a Roth conversion before the end of 2024, it needs to be completed by December 31st, 2024. It is not like contributions where you can kind of go backwards. It has to be done in the calendar year. Okay. Great question. Thank you. So just a rundown of their situation, right? Their total net worth is about $2.8 million, right? We're assuming a 6.5% rate of return. They spend a good amount of money. We've got inflation, but when you look at this net worth here, and then we focus in on the Roths, they only have about $25,000 in their Roth IRAs. So they heard about them, they thought it might be a good idea, so they put some money in there, but never really did much more with it. What we're going to do is we're going to look at and talk through what their retirement looks like as we extrapolate over like a 30-year plan. So when I run these numbers, and many of you who've gone through the planning process will be familiar with some of these charts that I'll run through. But again, I want to go through this quickly just to talk through the impact of Roth conversions and how we use them in planning. So we've got this high level. This is kind of what they do. They have a really good plan. If we have straight line growth, they still have $4 million left at the end of the plan. They're in a really good spot. But when we do our planning, we run something called a Monte Carlo analysis. A Monte Carlo runs 1,000 different simulations of up, down, sideways markets and says, what are the chances of success of this plan? And success is defined as not running out of money, which I think most of us would define that as being successful. When we run the Monte Carlo for them, it's a really great Monte Carlo score. It's about 83%. When I do planning, anything above a 70, I feel really confident. Anything above a 50, I feel pretty confident. But the closer to 100 we are, the better. But one thing I always like to balance, right? Not to, get too corny there, but one thing I always like to balance is I don't want to get to 100% just for the sake of being at 100%, because then we give up a lot of the use of those dollars that we could have done things that we love, that we enjoy with folks that we love, people we enjoy. So don't get caught up too much on the actual number, but more the magnitude of how decisions can change your financial planning picture. So if we apply something to this scenario, what we can do is use this 83 as kind of the base. And then if we can just pull one lever and we can say, what happens if taxes go up in the future? What happens if there's a 10% bump in all the marginal tax rates in the future? And that's the only thing that changed for Bob and Bonnie's plan. If that's the case, and that's the only lever that I change, the only thing that we pull, it goes from an 83 to a 72%. And again, for me, this is still a working financial plan. But the issue is the tax change is outside of our control. We, as much as we might try to, we effectively have no control over what the government's going to do, what the IRS is going to do, right? They're just going to do what they're going to do, right? So we want to, get rid of them and their volatility as much as we can. And this, again, is outside of our control. But if we do something that is within our control, and converting from IRA to Roth is certainly within our control, assuming we're doing the proper tax planning. So in this case, I went through and kind of looked at, from a tax planning perspective, what would make sense. They had this, and I'll get to it in a second, they have this valley where converting makes a lot of sense for them. And doing those conversions took them up to an 85%. And if we take that one step further and we say, okay, we did the conversions, it's a positive move for the plan. What happens though if that same 10% increase to marginal brackets comes through as it did in this plan right here? What if we tie it to the Roth conversions? And with that, it's still an 81%. And I just realized that the graphic doesn't quite fill up 81, but just pretend it's over here at 81%, right? But 81%, and all of a sudden what we've done is we have taken something that we can't control, which is future tax rates and changes to tax law. and utilize something we can control, which is current tax law and our Roth conversion strategies, our tax planning strategies. And we've put these folks in a better financial position just by avoiding, again, the risk of things outside of our control. So by taking control and doing what we can in the times that we can, we put them in a better financial position. And where this becomes a little counterintuitive is when we look at the tax, right? So this is side by side. Again, this is just using the softwares that we use, that I use to come up with these strategies. These people could have been sitting beautiful, paying zero tax for a period of 8 years because they had their they didn't have to turn on Social Security, and even when they did, it wasn't taxed because of where the other assets were. They could take distributions, and long-term capital gains was zero. Like, they could have just sat pretty. But what happens is we paid a little bit more in tax, and that improved our Monte Carlo score in both scenarios, even though we volunteered to pay tax. And one of the big reasons why, especially as we get older, is this little bump here that we see on the back half of the plan. So if we look here, we can see this is the actual income taxes paid, the two scenarios. On the left, right, earning income, all that stuff. On the right, earning income, our conversions. Then you can see, though, how it just jumps up. And hopefully y'all can answer this on your own as we go through. But if anybody knows why it goes up like this, you can shout it at your computer. I won't hear you, but I'll give you a sticker afterwards. It is because of what are called required minimum distributions. So at some point in your life, even if you don't want to take money out of your IRA, the IRS is going to force you to take money out of your IRA. So many of you, if you are over the age of 73, are already doing the required minimum distributions. If you aren't, you have lots of room to plan before those, but the IRS is going to force you to take distributions out of your IRA, whether you want to or not. And if we pair that, which is outside of our control, with higher tax rates, which is outside of our control, now all of a sudden we're paying a tax bill that we could have controlled a little bit by sacrificing a little bit in the beginning. But instead, we wanted to, just pay zero tax. But anyways, coming back to this, that's the RMDs that happen there. And what we want to try to focus on for any client is what's called this tax planning valley. And this can happen at a lot of different times in life. It can happen even while you're working. If you're in your 40s and you leave a job and you start a business, or husband and wife, and the wife keeps working, the husband stays home with the kids, or the husband keeps working and the wife stays home with the kids, and income goes down. Anytime there is lower income, then we have an opportunity to take advantage of that by understanding our marginal tax rates and creating some tax burden where there may have not been some, so that we can convert our IRAs to Roths. And again, we are electing to pay over the course of 8 years here, call it another $100,000 in tax in exchange for this lifetime growth. And to make it really kind of simple and visual here, this is on the left, and I'll uncover the one on the right in a second. This is just kind of the base scenario that we talked about for Bob and Bonnie client. The dark blue is taxable assets. Those are your brokerage accounts. That's the lowest rung of the tax efficiency ladder. Light blue is IRA. Orange is Roth. And this just shows that, listen, their IRAs, they're in a great spot, but they're going to be a huge burden to them over the course of their financial life. And the orange, it's there, but it's not as full. And if we compare it to the Roth conversion strategy, we can just visually see the difference between the two of how much now becomes tax-free resource versus what is, continue to be tax deferred and continue to be taxed. So again, these are the same growth rates on both sides. They're the same inputs, the same everything. There is nothing changed between the two. It's just the removal of that lifetime tax burden that we're paying off on the front end that gets us to this chart. So, I know this looks well and good all the way to age 90, but most of us aren't, at least we don't want to necessarily live that long, right? But I just want us to think about which of these two scenarios would we choose at age 80. So this is just pulling right off of these charts. And again, this is the software we use. Scenario one is the no conversion scenario, just kind of deal with whatever happens. Scenario two is the with conversion scenario. In scenario one, at age 80, there's about 3.9 million in investments. And now listen, this idea applies to whether you have 3.9 million or 390,000 or 10 million or 1.2 million. The number is irrelevant, right? The factor and the planning and the strategy is the same. So in scenario one, they've got 3.9 million. In scenario two, they have slightly less. They have 3.8 million. And it's like on the surface, it looks like scenario one is winning. But when we look at their tax-free Roth balance at age 80, in scenario one, it's 105. And in scenario two, it's $2.3 million. And if you're asking me, which one would I rather have, $2.3 million tax-free or, $3.9 million where most of it is taxable, I'm going to take scenario two all day. And beyond that, for those of us that want to leave something to kids or grandkids or whoever it may be, if a non-spouse inherits an IRA, they are subject to both RMDs and income taxes. They have to clear out an IRA within a 10-year period. So if I inherit my folks' IRA, which, hopefully mom and dad, if you're on here, that's a very long time away. But if I inherit it and it's $1 million, all of a sudden, in presumably my highest earnings years, I'm going to have to layer on another $1 million of distributions on top of the income I'm already earning. Whereas if I inherit a Roth IRA from a non-spouse, right, like my parents, there are still RMDs, but there are no income taxes that need to be paid at the heirs level either when it comes to Roth IRAs. So yet another reason that this scenario feels much better is because we can also pass that along to kids, grandkids, family members, whoever is important to us across the line. So I know I talked really fast and I gave a lot of information, and I hope that there's some questions. But before we get to that, there's just considerations, things we need to think through when it comes to Roth conversions. Number one, I think, dove way deep into it, maybe deeper than all y'all thought, but is our marginal tax bracket. That's one of the most important things we talk through when we consider Roth conversions. For those of you that are 63 and above, we also need to consider Medicare premium breakpoints. So if you're not familiar with it, and this is another software that we use that'll help us make a determination, but if your modified adjusted gross income is too high, so it's over 206, if it's below 206, you don't pay any additional Medicare premiums. If it's above 206 between here, you pay an extra $83 per month per person on Medicare. If it's up here, 320, and all the way up here, you can pay as much as almost $500 more per month per person in Medicare premiums. So that's another consideration that we bake in. We want to say, okay, not just the marginal tax brackets, but also, are we going to crush ourselves with Medicare premium increases or something like that? Of course, income sources and taxation. If you have pensions coming in, if you have Social Security turned on, if you have different resources, right? Like that is all going to matter. If you have rental income or business income, all of these will factor in. The age of you and your spouse is going to be a big one. Obviously the impact of paying a little bit more in tax at 35 is far more beneficial than at 75, but it still can make sense to defer at 35, and it can still make sense to convert at 75. It's all an individual approach here. Your spending needs, of course, family legacy goals, how you want to pass things to the next generation, and charitable intentions as well. And charitable intentions is something I'll dive much deeper, but if you are charitably inclined, you could potentially do Roth conversions and pay very little in tax in them if we pair it with charitable contributions. And that's something we've done for a number of clients over the years as well. So if Roth conversions, and I know I kind of dove through it as this was a real crash course, like drinking through a fire hose. But if you want to have a conversation about this, and many of our clients and many of you on this call, I believe, already have. But what we did is we put together a income planning intake form that we'll send off with this recording and with this webinar as a follow-up to basically gather all of your income data for the year, right? So instead of me emailing you and you emailing me back and all that stuff, a consolidated place to enter it'll be really helpful for you and for us. It'll also have a place to upload your 2023 tax return, which will also be very helpful. then we could set up a time to go through a plan and the tax strategy. And for everybody on this call, if you don't do anything after this, talk to us at least about opening up a Roth IRA if you don't already have it. Most of our clients already do, but if for one reason or another you don't, let's open up a Roth, do a small conversion before year end, and start that 5-year clock so at least you have that planning flexibility. So again, I know I went really fast. I think I talked for about 30 minutes. So I apologize if I'm a little bit over that. But now I'm going to open up for any and all questions, concerns, or thoughts as it relates to Roth conversions. Do we not have
Don't
any?
see anything. Don't see anything coming through right now. Ryan, do you see any on your end?
Nope, nothing yet.
Yeah, certainly a lot of information there. But I mean, who do you see? I mean, I could share this too, but from the general clients that we work with, I mean, who do you kind of see as almost like the prime candidate to sort of make sure they're looking at this on a regular basis? Is there something that comes to mind? Yeah.
Yeah, no, that's a great question. I think that anybody it can make sense for. Again, I mentioned it, whether you're 35 or 75, it can make sense to talk about Roth conversions. And the best part or the best place, and I'll kind of skip back as quickly as I can, is for those folks that are right around that retirement period, whether it's coming here shortly or it just happened, whatever it may be, and they're in this tax planning valley after their highest earnings years. Now they're retired. They're, taking their income. This is the prime area to be doing a lot of these conversions before we get to required minimum distribution age, right? So that would be first and foremost. But anybody that just has, an IRA that, wants to look at kind of the long-term impact of the tax-free resources versus the tax-deferred can be a great candidate for this. So everybody should go through the exercise.
That's awesome. And then another question I had too is I've heard in the past sometimes people are like, well, I want to wait till the market crashes down so my portfolio is worth less. So when I do the conversion, I pay less in taxes. Like, any thoughts about that? I know it's almost impossible to time the market, but any thoughts there? We do have a couple more questions that came through the Q&A too.
Yeah, so I'll answer that first. That's a great point. So generally, we do these conversions near and around year end. That's why we put on this webinar here at the end of October, because it still gives us 2 months to work through it for any and all clients. But for those of you that have been working with me through COVID, we did a ton of conversions for clients in March and April of 2020. When the markets took this big dive, we didn't let it scare us, so to speak. We more took advantage of it by converting at a time when markets were down. So we didn't try to time it. We just saw when the opportunity arose, hey, let's convert while accounts are down. Let's do this now. And then, see what happens. But for those of you, if any of you were on this call that did that, I know just from a growth perspective, it ended up being really good. But that's a great point, Tim, that from a timing perspective, end of year tends to be the time we do it because we know kind of how income shakes out, but it can happen anytime during the year, and using volatility as a opportunity is a great way to leverage that.
Awesome. Ryan, you want me to go ahead and I can just ask those ones that came in? Charles asked, the Roth inheritance, does that roll to another Roth of the recipient? Do they have to have a Roth set up in order to have that roll to them? I think that's what he's asking there.
Yeah, great question. The recipient does not need to have any sort of Roth IRA already set up. They will just set up what's called an inherited Roth IRA, and then that inherited Roth IRA will become their property, so to speak, and it will go to them.
Got it. Figured that. And Charles, follow-up question there. Just should I figure out my taxes in December? I mean, I guess the answer is kind of we can take a look at that and get a idea of what it's going to look like, right? And do some planning accordingly.
Yeah, that's exactly what we want to do. We want to take the information now that we know that, hey, these distributions have come out, this Social Security has come in, this earned income has come in, this rental income, whatever it may be. Then we can extrapolate and we can say, okay, for November and December, this is what we can assume. We can safely convert $30,000 or $10,000 or $100,000 based on this info. And we don't want to be an analogy I use is we don't want to be like Icarus, right? We don't want to get too close to the sun that we burn off our wings, right? We want to be smart about where we fall for marginal tax rates and for that Medicare premium. without getting too close to the sun.
Cool. Awesome. A couple more questions here. So can we contribute to a Roth to start the clock, or do we need to convert an IRA to start the clock? It's a great question.
Great question. Either way starts the clock. So if you make your contribution in 2024 to a Roth IRA or to your Roth 401k, that'll start the clock for January 1st, 2024. So it goes back to the tax year you made it, or you can do the conversion. Either one will start that clock as of January 1st.
Okay, got it. And then one other question we have, at least that I'm seeing here, there is a couple more. Can you do a contribution to your Roth IRA and a conversion in the same tax year?
Yes, you can. So as long as, if we do the conversion, so that's a great question. Let me see if I can skip to the adjusted gross income slide, because there is actually a client of mine that we are doing this exact thing for. Let's see, is the AGI limit up here?
Yep.
Yes. So
Yes.
if you say your income was $180,000 adjusted gross income, and you wanted to both contribute and convert, what we would do is we would say, okay, your AGI is 180. Let's convert 30, maybe, right? To take your AGI to 210, stay well below the AGI threshold here of 230. And then we can also make our Roth IRA contributions of $8,000 a piece for the husband and wife. So there is one client in particular that we are doing that exact strategy for. That's a great question. And again, that's why going through the process can help us to understand the best way to get money in. Because at the end of the day, if you can make a contribution, this is better than doing a conversion. I would rather contribute $8,000 than convert 8,000, because if I convert 8,000, I pay taxes on it. If I just contribute it, yes, technically I've already paid taxes on it, but I've already paid the taxes on it and it's just going in without that extra tax, right? So great question.
Got it. Laurie had a sort of clarifying question too. Required minimum distributions, they apply to Roth beneficiary IRAs. Roth IRAs don't require distribution until after the owner's death. So do you have a clarifying around that? Yeah, that's right.
That is correct. So Roth IRAs do not have a required minimum distribution schedule for the account owner. So my own Roth IRA, I do not ever have to take required minimum distributions out of my personal Roth. But if my son Mitch inherits it, that's when all of a sudden a required minimum distribution gets applied to the Roth IRA. It's only inherited by a non-spouse.
Cool. And do you know offhand, is the Roth similar, Bob, where you have like that 5-year, you have to do it type thing, or you can do it for 10 years? Is it the same kind of thing that they switched into a few years ago? I don't mean to put you on the spot.
It's a 10-year. Yeah, it's a 10-year.
10-year. Okay.
It's a
you basically want to get it all up by 10-year.
Correct. Yep. You have to clear out. So any inherited IRA, whether it's Roth or pre-tax, it needs to be cleared out within a 10-year period.
Cool. A couple more questions. One from Sarah. When you say you can withdraw your own contributions tax-free from your Roth once converted, can you explain again what you mean by your own contributions? There has been growth inside the regular IRA and contributions to the regular IRA. Are those the contributions you're talking about?
No. So let me see here if I can find a slide that may help with this. I can't quickly, but the idea is, so if you have a Roth IRA and you haven't hit the 5-year clock yet. So if you've hit the 5-year clock with any of if you've had a Roth IRA for at least 5 years, this question is not, it doesn't matter, right? So for a lot of my clients, they've had a Roth for at least 5 years, you're good. But if you just set up your Roth and there's $0 in it today, you go and after this, you put in, $1,000. If within 5 years, you need to take that $1,000 back out, you can take your contribution out, the amount you put into it. But if it grew to $10,000, right, that 10x, you bought the next NVIDIA, right? That 9,000 of growth is what you cannot take out without penalty and tax until you're 59 and a half and have had it in there for at least 5 years. So it has to do with the amount that you put into it. An IRA is completely separate. An IRA, it doesn't matter, the contributions, the growth, anything is taxed at ordinary income and is subject to a penalty if you take it out before 59 and a half. A Roth, it's your contributions, the conversion amounts The conversion amounts, there's some nuance there, but your contributions are always, you can pull it out tax and penalty free.
Okay, awesome. Sarah, let us know if that answered that question. And last question we have here, Greg, can you talk about the timing of paying the taxes and the source of funds for paying those taxes? Because
Yeah,
you
great
know we don't
question.
have a
So
yeah.
yeah, so in Bob and Bonnie's circumstance, so let me just flip over to Bob and Bonnie's kind of breakdown here. So when we think about the tax efficiency ladder and when we do these conversions, Bob and Bonnie, I want them to pay the extra tax out of this joint account or out of this savings account, right? Because then they're removing it from the lowest rung of the tax efficiency ladder and leaving as much in the Roth as possible. But if they convert $50,000 from IRA to Roth, they have a few options. One, they can just withhold taxes on the conversion. So they could say, hey, $50,000 conversion, withhold 20% in taxes. So send 10 grand to Uncle Sam. All that's going to fall then in the Roth is $40,000. So you've converted 50, but you only move 40 into the Roth. And it's like, yeah, that's fine, but that might not be as ideal as if we could just write a check for that $10,000. The taxes due when you do a conversion is it has to do with kind of how your income lays out over the year. But generally, the IRS wants you to pay your taxes quarterly as you realize income. So if you convert in, say, August, technically you should make an estimated tax payment or withhold on that by, October 15th, I think is the one that's due after the third quarter, right? But with some planning, so this is where it comes in too. There's other clients that with how their income is stacked up over the year, they have already withheld enough in taxes to cover the conversion, and they don't have to do anything to write a check or to withhold anything from the conversion. So yes, considering where to pay the taxes from is a big part of it, and that's again back to the overarching plan, like kind of how and where do we want to pay that. But it depends on, again, your circumstances, your resources, and the amount that we convert as well.
Fantastic. Well, that's it for the questions from the public. If there's any other questions, feel free to throw them our way. And phenomenal job, Bob, taking this strategy and getting it out there to folks. As always, we never do planning in a silo. We really want to do a deep dive with folks, and we're happy to just jump in. If anyone's on this call that doesn't know us yet personally, reach out. Love to chat with you. Just do a complimentary call to introduce ourselves. And we stand behind our fiduciary duty, doing what's best for the clients. And so these are just value added times. We'll have some more of these coming up. I think maybe one more before the end of the year. Is that right, Bob? Coming up in November, maybe?
Yeah, I think we're going to try to do one. Yeah, we're going to try to do one more. It's not settled on the topic yet, but we'll certainly keep you all in the loop for what that's going to be and when that will be. But, and as we're wrapping up here, I'm going to throw my other disclosure up here on the screen just to make sure compliance is happy with me properly disclosing everything. But again, as Tim mentioned, if there's any other questions here in the short run, please feel free to drop them in. I'm happy to sit here for as long as we need to go through those. But if not, again, we're going to follow up with an email that will have this recorded. You can watch it again if that would so interest you. If you want the slides, we can get you the slides. And if you want to go through the tax planning conversation, be on the lookout for that that income planning intake form and get that back to us, and we can make sure to go ahead and get everything handled here as quickly as possible.
Awesome. Ryan, I think that's pretty much it. If you anyone else out there needs anything, let us know, but we're happy to help you and chat to everyone out there. Thanks for the support and joining us. And thanks, Bob, for your time, Ryan, for all your help. We'll be in touch soon. Have a balanced night.
There you go, Tim. Way to sign it off, right, man? All right. Thanks, Ryan. Thanks, everyone, for being on, and hope to hear from you all soon.
Have a good night, everyone. Bye.
Take care. Don't eat too much candy.